Everything on this channel is for education only and shouldn't be taken as personalized financial advice. Not all dividend companies are created equal. Today, I'm going to be breaking down my dividend growth tier list, which will end up ranking stocks based on 6 key metrics. First, the dividend yield, and this tells you how much cash you're going to get relative to the stock price. And then next up will be the dividend growth, and that's just simply how fast the company has increased its dividends over time, and it's definitely a key metric for dividend investors. Next up will be dividend safety, and that just looks at the payout ratio and the likelihood that the dividend can be maintained. It's another key metric that we're going to put a lot of weight on. And next is the financial safety, and that's going to be measured by the debt to EBITDA ratio, and it's adjusted for REITs and BDCs because they're just a little different when it comes to debt. The next metric is the earnings growth, whether that's EPS or adjusted funds from operations, AFFO for REITs, or NII or net investment income for BDCs. This measures how earnings or cash flow is growing over time. And last but certainly not least, ROIC, or return on invested capital. And that measures how efficiently a company uses its money to generate returns. And each metric is going to be scored from 1 to 5, and in some cases weighted based on its importance. Once those scores are added up, that total determines the tier, right? That'll be your S through your F. So now that explanation is completely out of the way, let's break down the stocks. And we're going to get started with Lowe's, ticker symbol LOW. Most of us know Lowe's. They're a leading home improvement retailer serving both contractors and everyday consumers. They sell everything from tools to appliances to building materials and a bunch of things that you didn't know you ended up needing until you walked in. You definitely need that new power tool. All right, so let's break down Lowe's. Starting off with its dividend yield, it does have an impressive 2.02% yield. That's not huge when you look at, say, Realty Income when we get over there in a second, but it's also not tiny like Google's or, Meta's or anything like that. So 2.20%, pretty respectable. And a number that I like to target is roughly around 2 to 4% in my portfolio. All right, so going to the dividend growth, it does have an impressive 15.61%. And as a dividend growth investor, these are the numbers you want to look for. These are the numbers that are going to help drive your growth over time. All right, and then also the dividend safety, they're only utilizing 38.65% of their free cash flow to help pay for this dividend. So very safe, and a number that's ideal. The one that's commonly thrown around is around 60% or less, and so they're well under that. The financial safety is going to be a measurement of their total debt versus divided by their EBITDA, and effectively that's just going to measure how many years of current earnings it would take to pay off all their debt. And here we see for Lowe's a 3.6, meaning it'll take 3.6 years for them to pay off all of their debt. Its earnings growth, if you want to take a look at that, is 15.47%. Very respectable, as we always want to see the earnings keep going up faster and faster and faster. A good number. And then next up is their ROIC, or the return on invested capital, and it's a very important measurement to see how they're spending their money, because they only have a few options that they can do with their leftover money, right? You can either pay a dividend, you can go reinvest in the company, which is going to be this ROIC. Their ROIC is returning 26.79%, which is a very respectable return on the invested capital. So they're spending the money in the right way, and it's just more of a tell that the management is doing a great job. Altogether, Lowe scores 41 points, placing it firmly in the S tier. What's great about Lowe's is that it also has a solid total return, up 1.46%-ish year to date, while the S&P 500 is down around 3%. Pretty impressive, honestly. Something interesting about Lowe's is the supply chain improvements and continued demand in home improvement have supported both earnings and the dividends. All in all, Lowe's combines strong income, growth, and safety, making it a classic S-tier dividend growth stock, a swan, if you will. Next, we're going to look at Realty Income, ticker symbol O. It's a REIT that's well known for its monthly dividends. For Realty Income, we have a dividend yield of 5.04%. A very high yield indeed. It's very nice. It's something that you do want to see if you're income focused. But it does balance out with the dividend growth, which is only 3.53%. So if you have a long runway, maybe Realty Income isn't the best fit for you. I mean, you can always combine those two numbers together. That's something that a lot of people will do, and they'd say that would be like an 18.57%, 8.57%. And that's a respectable return, but I disagree here. I think that for many dividend growth investors, while Realty Income is pretty cool in what they do, I would probably save this for when I'm either prepping for retirement or I'm in retirement. Either way, its dividend safety is really good. It's at 73.91%. And I know I said that, 60 or below is the best, but Realty Income does aim for higher. They try to keep it around 80%. But so they're actually below that. And I think that's more so kind of focused on what they're expanding their business or where they're expanding their business. So we'll see how that goes. Financial safety is 5.76, meaning 5.76 years to return all of that. And so the REITs, they're gonna be pretty debt intensive. It's just the nature of the beast. It's with when you start buying real estate, etc. You're gonna get tied up with more debt. So I've adjusted the scoring for REITs on this, so they're going to be scored appropriately for the increased debt. Next up is earnings growth, and this is going to be your AFFO for a REIT. Typically, I like to use EPS, your earnings per share, but REITs and BDCs, which we'll cover in a later video, are a little bit different. So we see their earnings growth at 4.77%, which is honestly pretty decent. That's something that you could like. Their return on invested capital is 2.37%. Not the best, but not the worst. Realty Income scores 27 points, landing solidly in the B tier. While it offers a high yield and safe dividends, its slower growth and lower ROIC keep it out of the S tier. Realty Income recently announced some new lease agreements in retail and industrial properties, which does support long-term dividend stability, which makes it good, but it's got a different goal if you're looking for dividend growth. It's more of an income stock. So even with the slow growth, its monthly income and reliability do make it attractive for income-focused investors, but that's not going to be a perfect fit for those of you with much longer runways. Finally, we have Target, ticker symbol TGT. Target is a major retailer in the discount and general merchandise space, and it's a tough space to compete in because you're fighting with these giants like Walmart and Costco. But it's not an impossible space, and Target isn't a small dog in this fight. And their dividend yield is sitting at 3.89%. Really good. I mean, yeah, that's really good. Normally they sit much lower, but that's also due to the massive sell-off that's going on with Target right now. A story for another time, I guess. Their dividend growth is at 10.95%, which is also very good. That's something that I would like to see, or I'm happy with as a dividend growth investor who wouldn't want to see almost an 11% raise every year from their investments. That'd be awesome. The dividend safety is sitting at 59.71%, so below that 60%. Their financial safety is sitting at 2.51, so excellent, right? They're really good at managing their debt. They can pay it all off in about 2.5 years. Really, really good here. But here's where the cookie ends up crumbling a little bit, or dissolving in your mouth, and not in a good way. It's their earnings growth is sitting at negative 1.21%. So let's jump back to that dividend safety metric where 59.71% is good, but I expect that number to keep going up, especially as that earnings growth continues to go down. Hopefully they can reverse it. They did hire a new CEO. And if they can do that, then good. Then Target could be a good source of your money. Just know that, you're competing with Walmart here and also Costco. But what is important to know with those is that if you look at the PE for those companies, Walmart and Costco specifically, you're looking in the 40s, whereas Target is much lower. Let me look it up real quick. Target's PE is 14, so much more reasonable if you're bullish on Target. All right. And their ROIC is at 12.51%. Very good. That's something that you would like. But all in all, they do end up scoring with a 28, which puts them solidly in the B tier. It has a strong yield, a safe dividend, and manageable debt. But recent earning headwinds limit its growth potential. Target has faced margin pressure due to rising supply chain costs and competitive retail dynamics, which explains the negative EPS growth. That said, the dividend does remain secure, and the company is still a solid pick for a diversified portfolio, but I would definitely keep an eye on this one, as shrinking margins and slowing revenue growth are worth watching. And while it landed in the B tier, I could see it slipping into the C tier pretty quickly if the company doesn't get its act together. So to recap our three stocks, Lowe's is sitting pretty in the S tier with solid yield, strong growth, safe dividends, and top tier efficiency. Realty Income lands in the B tier, offering high yield and very safe dividends, but slower growth and low ROIC. Essentially that keeps it from moving higher for now. Although with their plan, I don't really see them kind of deviating from that, but we'll see. You never know. Target also lands in the B tier with strong income and dividend safety, but slow earnings growth continue to hold it back. So what do you think? Are these ratings fair? Let me know in the comments down below. And if there's a company you want added to the tier list, drop it on down there too. I'll be going through them to help kind of influence my future videos. All right, so until next time, stay consistent, stay invested, and build your future one divvy at a time. Take care. Bye.